Okay, good afternoon, guys. Welcome to another live trading clinic. I'm Steve Ruffley. We're going to concentrate on the Bank of England today. So obviously we've got the ECB a little bit later on, and I think the majority of the times the press, which know very little about real trading events, to be honest, kind of always think these are going to be a damp squib, not going to be of much interest to the markets. But I think I've demonstrated over the colossal amount of webinars that I've done over the years that it doesn't really matter what people perceive to be important, okay? The reason why I, Steve Ruffley, someone who's done 1,000 webinars, is sitting here today talking about the Bank of England, because it's important. Now, I'm not interested about being right, okay? I'm right more often than I'm wrong. I'm interested in making money. One of my best quotes that I've used over the years is trading's not about being right, okay, in your opinion. It's about being right at the right time and making money. That's what trading is. There's a lot of educators in FX Street who do not know what they're talking about, okay? I'm not going to name any names. I don't need to. But people that put catchy titles of things, people that have no real experience, okay? Now, I've traded the markets about 14 years. I've made more money than most of these people put together. The reason why I've done so many webinars is that I'm like I'm one of these educators that tells the truth, okay? Trading is hard. You will generally lose money. Okay, if you want a quick fix to trading or you want something that's going to suddenly turn you around, you're not going to find it. You're not going to find it for free. Okay, it isn't possible. Trading takes an enormous amount of time, an enormous amount of energy, and it's not to do with understanding Fibonacci. It's not to do with understanding, any technical study. It's about understanding yourself. Now, the reason why I mentor clients one-to-one, and I've got people with not millions, billions of pounds. Okay? I don't deal with the retail customers on a day-to-day basis apart from these webinars. When I'm talking to people, I'm talking to people that are smart, savvy, clever, that have made colossal amounts of money from different types of business. Then they come to trading and they can't handle losing money. They can't handle that they can't do it. Okay? It's a very frustrating thing to undertake trading. The whole thing about trading is it's not about being smart. Some of the smartest people I've met have made the worst traders. Trading is about understanding yourself. If you understand yourself and you understand how you want to interact with the market, then you can start to build a strategy around that. If you don't understand yourself, you have no chance of making money in trading. If you don't understand yourself and how you want to interact with a particular market, you have no chance of making money. I could carry on that list. There's a lot of things going against you if you're trying to make money, okay, in the markets. There's so many different types of ways of trading, and again, you can Google these things and you'll get just these, the same generic answers. I'm just writing, the last part of my book and some other, new courses I'm doing. And the thing that resonates through is that people are always looking for a new answer to trading. There is no new answer to trading. Trading's exactly the way it used to be. It hasn't changed. Okay, there's algorithms. There's more people in the market. There's high frequency trading. That hasn't really changed anything. Okay, all you're ever looking for is value. Where to buy something when it's cheap, or to sell something where it's expensive. That's it. Okay? The rules of the game may have got a little bit more complex, but essentially all you're doing at any point in time is hunting for value. And if you can break trading down into them basic elements, you're going to be a lot better as a trader. So all these magical, mystical ways of trading, Elliott wave, Fibonacci, sure, I use them all. Okay? I understand them all. But the reason I make money consistently is that I understand how I interact with the market. I understand when I want to get in, how long I want to be in the trade for, and how much money I want to make. And those basic elements outstrip all the other reasons for being an amazing technical analyst or being an amazing fundamental trader. They're just parts of trading. The markets will move 80% of the time due to a technical move. Okay, so markets will move between support and resistance because the majority of people out there are using technical analysis. 20% of the time, they're going to move for fundamental analysis. Okay, things that are new news, things that are coming into the market, new data. Okay, and that's what we're concentrating on today. So the market might not be expecting much change. Okay, the commentators might not be expecting much change. I don't care. I'm not interested in what they say. I'm interested in if the market will do something, if I understand it, and can I make some money from it? So I'll focus on gold. I'll focus on the FTSE. I'll focus on, cable, the pound versus the dollar. Okay, all these things that we're listening to today set a tone, set a ripple through the market. I was absolutely sure the UK was going to be the first to move on interest rates, and now all of a sudden it's all turned on its head. So instead of seeing this big bounce that we were going to see after the 7 months of selling in cable, we've actually seen a bit of a bounce, and now we're looking a bit negative again. Because Janet Yellen, the Fed, have started to make noises that it isn't 2016 when interest rates are going to go up. Maybe it's June of this year. Maybe it's sooner. It's all changed. And with the general election in the UK, nobody's talking about interest rates. No one's talking about the housing bubble in London, yada, yada, yada. So it's all kind of quickly shifted that huge fundamental landscape, and that my view now has totally changed. And that's what you have to do as a trader. I can be as sure as I'm sure about anything, and then when I get some confirmation or when I get an inkling that something of my own has changed, then you've got to adapt to it. Okay, I can go through every market and tell you things that I've not just said, for the fun of it. I've said over the last 18 months on FX Street webinars. I've said in the Financial Times. I've said in Bloomberg. And all these things will happen, okay? Because I just have the benefit of a vast experience in these things. And again, I'm not interested about being right. I'm not interested in having a quote in the FT and going, pat on the back, Steve. Aren't you clever for predicting that? I'm not interested, okay? I'm interested in me, Steve Ruffley, sat in my office here, making money from that. Because I don't make money from it. What good's a quote in the Financial Times? Nothing, is it? So all the things I teach in this training clinic today will be about understanding that you have to discount a lot of what the noise is. And the noise is anybody outside of you. Okay? You can't control the markets. You can't control what other traders do. You can't control the news. You can't control anything. As a retail trader, you're the lowest of the low. Okay? You trade off a spread betting platform. You have a lag. Okay? If you make money as a spread betting trader, you're doing very well because everything is against you. Okay, but you don't pay £2,500 to sit at a professional trading floor in London. You pay nothing. Okay, all you pay is the spread. So again, you can't get angry about this. I've made £10,000 in the last 6 weeks of trading just by being in the markets, just by being, buying and selling, and that was with a £4,000 loss in the DAX. Okay, now, that's not to say that that's my job. So of course I should do that. But I'm trading like everybody else does. I don't, sit in my office. Okay, it's a nice office, whatever. I've got all the kind of mod cons. But essentially, what I do and what I kind of prove my education works and my strategies work and my interaction with the markets work. And the reason why I've done some of these webinars is they work because I trade like everybody else. Okay, I trade off a spread betting platform on IntraTrader that I'm the chief market strategist off. I use free demo MT4 charts. So that's it. Okay, I've afforded myself a squawk, so I pay for that. But essentially, I am trading like any other retail trader out there. Yeah, I have access to Reuters, all the mod cons on Reuters, Bloomberg. I get these free because of who I am. I don't use them because that is what professional traders do. I act like a professional trader mentality in the retail market. So every pound I make can be made by anybody else that listens to my webinars. Yeah, that's what's important. So what I'm doing today is I've got the account open. If I see something interesting, I will trade it. But I'm going to show you how you can use any spread betting platform, and any free copy of MT4 charts to get an idea of what the market's doing technically. And then you use examples like today of this fundamental driver within the market to then put your trades on. So if you think something is said or not said from the Bank of England, then you're going to have to focus on cable, anything pound-based, and that will make it more valuable or less valuable. So you trade it in a technical manner. Okay, you'll hunt out that value. So before I start, as always, the risk warning. Remember that spread betting and CFD trading carry high risk of capital, resulting in losses in the initial deposit. They might be suitable for everyone, so please ensure you fully understand the risks involved. The information and comments provided here under no circumstances I'll consider or offer solicitation to invest. Nothing here should be issued investment advice. The information provided to you is accurate. The data is produced. Education only. The content on the webinar is posed opinion of the moderator at intro.com. The content is not constitute financial investment or tax advice. Intro.com is not accept any liability of the content and comments made during this session. So I'm going to cover live charting analysis. Again, the only way I know how to trade, multiple time frame trading. The fundamentals will come to at 12 o'clock. It will be unchanged, invariably. Doesn't mean there won't be market movement. Doesn't mean there won't be comments after that. Real money trades. I only have a trade a live account. There's no point pretending. And Q&A. You've got unparalleled access to speak to me while I still do these webinars. So ask me anything, okay? Don't ask me something stupid because I don't tolerate that kind of stuff. But ask me something intelligent, and I will try to give you some best of my ability and insight into anything fundamental or anything technical. So yet again, we are seeing the DAX power higher. Now, if you want some of these clever quotes and some of the, said, oh, aren't I good for predicting this? Here you are. I will give you 55 ticks. The FTSE will hit 7,000. It's inevitable. There is absolutely no doubt in my mind that the FTSE will hit 7,000. Okay, when you've got the DAX trading above 11,500 near enough, the S&P holding way above 2,000, the Dow Industrial making inroads above 5,000, then the FTSE, okay, has to hit 7,000. It's not just a technical level, it's a psychological level, it's a fundamental level. It will hit 7,000. Okay, so I've been saying this for the best part of 9 months. That's been said in the Wall Street Journal, Bloomberg, and Reuters. So that's my little bit of credibility. The other one is also gold. I've been a big gold bear for a long time. So basically, every time I see a high in gold, I sell it and I generally make money. So this was a trade I did yesterday. Quite nice. Okay, I certainly didn't take it all the way down here, but I got a good chunk of this move. So every time that you see things like this in the markets, my red lines, which are just Fibonacci's, as I said, based upon certain principles, red lines are sell, 50 is the pivot point, then you buy it back at the green lines. Now, you can't say these things are not, good, solid levels, can you? When you see the market and how we're trading now, again, it's another prime example of trying to pick out a level of interest within the markets. So I found that this point here was a level of interest in the markets. So you can see yet again how the market sold off, came back through, made new highs, but then the 50% was always this key pivot point. So we're finding now that the markets at the top side are finding resistance on these upper levels, so the market's going to go down. Now, in 2013 to late 2013, it was quoted in the FT, and actually a printed piece saying that by early 2015, gold will be trading closer to $1,000 than 1,900. So again, we're a little bit off that, but we're not a million miles off. I would say that now gold is starting once again to hold below this 1,200 level. We've really only got 1190 and 1184. It's not on my charts here, but around about here, 1182, 1184 is a massive level. Okay, and once we break that, technically speaking, then gold is going to drop like a stone towards $1,000. Now, there's all the reasons under the sun I can tell you why gold is going down, but the main reason is, okay, there's more fear in the world now than there ever was. So if gold was going to be a safe haven, okay, and a place to put your money in times of uncertainty, it would have tried to get higher than it has now. If it doesn't go up, then it's going to go down. The reason why it's not in the world's interest for gold to be as highly priced as it was, you don't see any more cash for gold anymore, do you? You don't see any more adverts on the TV. Okay, the UK, as we know, famously sold all the gold at the bottom. There's rumours that Fort Knox is empty. The people that have, and when I say people, I mean countries that have large amounts of gold are not generally the West's favourite people. So it's in no interest for the markets to be back up. All the big hedge funds are out of gold now. There is nothing that's going to be able to push gold up. If it can't go up, it has to come down. Okay, I'll show you as simple as I can. Technical analysis, the reason why 80% of the time, I'm right about these things. Okay, gold's going to go down for this reason. Low to the high. Okay, so we're taking the low from back here in kind of late May, June 2008, up to the high here in 2011. Okay, 8% of the time, a strong directional move will retrace to 50%. That is a strong directional move. We've retraced to 50%. Okay. Oh, sorry, that's the 38.2. Sorry, I just wasn't concentrating there. But yes, 8% of the time, the market will retrace to 50% as it is. Now, you tell me if that's acting as a good level of support or resistance. Okay, you don't have to be a great technical analyst to know that's acting as absolutely, perfectly a point of attraction. Okay, and when we had that last spike up in gold, the best sell you could have ever done was up here at this 50% point. The market's going down. So when the market hits this lower point, as I've said again, from the fib levels, 1184 and 82 is really where it's going to start to get interesting. But when we hit 1159, then there's nothing below that. All we can really target is lower levels of support and resistance, and then key psychological levels, which is $1,000. So do whatever you like. I mean, again, I'll sell every high in gold anyway, and as an intraday trader, I make good money from that. I don't want to have to hold gold from here to here to make 1,500 ticks, to make 3,000 ticks. I'm not interested in that style of trading. That's investing. What I want to do is sell every intraday high, every key hourly high, everything that I think is overbought in gold, and sell it down. So technically speaking, all we have to do now is if we want to do a very ambitious trade from where we're trading now. You put your stop here. So you put your stop here, and you're risking, 1,500 ticks to make 300 ticks. So it's not good enough. You'd have to hold it to here to make 2,000 ticks. Okay, so stops above here, and you target me down here. And below 1,000, I have no idea. I really don't know. I don't think that far in the future. But again, having this key framework, this understanding, and this ability to just do one type of trade. Okay, I like to say that I'm market neutral and I can buy things, I can sell things without any bias, but I'm a human being. Everyone has a certain bias. So I'm generally fairly confident when I see big spikes up in gold that I can sell into it an average and I'm going to get a return because gold's going to come down because I believe it's going to get to $1,000. And if you have that kind of mentality, you don't necessarily win more trades, but what you do is you lose more trades. Okay, because you hold trades for that little bit longer, you're a bit more aggressive with your averaging, and you don't get out for that big loss. Okay, now I trade very, very aggressively. Instead of the things that everyone else will teach you of trading 1% or 2% of your margin on each individual trade, if I need to, I will trade 100% of my account on an intraday trade. Okay, I'll probably do that 1 in 3 trades. Yeah, I'm a very aggressive trader, and I know when the market's being manipulated, and I know because I teach it. So I know what the retail traders are doing, and I've also been a professional trader, a real professional trader, not the so-called expert traders that you hear about in other kind of webinars. I've actually traded £1 million accounts. I'm a real trader, so I know where the pain in the market is. So I like to buy and sell into that pain for a short period of time, again in order to profit. So getting back to gold, I mean the whole point is all the fear was up here. But the market couldn't hold on to any of these high points of fear. So once we hit below this 1308 spot 72, 50% retracement at this upper move, it's all downhill from there. And all you do is take that framework, go to your weeklies. How good is that for a sell? Where's your next point of attraction? Here. So we're either going to bounce up or we're going to break. Daily. Same scenario. Every time that the market looks strong, when we hit them high points, we have a consolidated point of selling. Yeah, so rejection of these highs, lots of selling. Get back up, lots of selling. Get back up, lots of selling. So look for that pattern. Yeah, if the market now gets back up to here, lots of selling. That's all you're looking for in trading is just patterns and history to repeat itself. So that's just the hourly gold. So again, as I say, look for them highs intraday and sell them. It's not more difficult than that. So regarding cable, most grateful of your expert perspective. Are you expecting a daily close below 1.5210, a test? Okay, well, let's just look at the chart. As I said, I mean, going back to the monthly, you can do exactly the same as just done on gold. Okay, so blank chart. Now, as I said, on FX Street particularly, I was saying that I was expecting, a bit of a resurgence in the pound for a number of reasons. The first one was that I believe that interest rates were going to move first in the UK to tackle the problem of housing, free money, cheap money, and just a general kind of, set of circumstances that got into the first credit crunch. We seem to have learned absolutely nothing. So when the credit crunch 2 happens, nobody can say, we weren't warned. Now, what I was saying is with that 50%, it's very, very, again, important to understand where we've been and where we're going to then go. So the market, again, sold off very aggressively, absolutely conveniently at the same time as gold rallied. So no surprise there. So we've seen this big kind of downturn in the pound. Then the market's kind of consolidated, but towards the higher end. I mean, it's not amazing technical kind of trading here, but we were looking as if the market was regaining strength. And as the market was talking about a potential hike in UK interest rates, so if interest rates are higher in the UK, more people put the money into pounds because they get a better return. Okay, so I was expecting we're going to hit this 50%, maybe hold above it and get towards 1.82 and maybe higher. But be it, again, other fundamental reasons, be it whatever, the market, sold off. We sold off very aggressively for 7 months, and we're trading quite technically here below this level. And obviously, after 7 months of selling on the monthly charts, you're going to see some green. Okay, you're going to have to, because people have to take profit. But instead of seeing the market bounce aggressively higher, hold above this and get towards the 50%, as I anticipated, I was wrong. Yeah, I was wrong in my opinion that the UK would move first on rates, because now it looks like the US might move first on rates. And if they do, that's going to bring further strength into the dollar, therefore ergo means that the pound is going to be less attractive. So what we're probably going to see now is 7 months of selling. We've seen the institutional profit taking here. We're probably going to see some consolidation towards a month, and then the pound head towards 1.34. Because if the UK continues to dither, continues to argue about can they, won't they, will they, won't they, da-da-da, whatever, these things are cyclical. You know, they're outside the government's control in the long term. Okay, in the short term, and, you know, we've been a very long short term here, we've been able to keep interest rates low. Okay, so that has meant that the pound was, you know, fairly attractive for investment purposes, you know, for buying property, etc., and borrowing money. And we've seen this weakness come into the pound. But now we're talking about the US moving on rates before the UK. We're not going to see that rally back in the pound that I expected because, you know, the dollar is going to be more valuable as an investable monetary commodity than the pound is. So what I'm saying is that now we're below this trend line here at 1.5661. I'm now anticipating, rather than a bounce back to 1.82 and strength coming into the pound, I'm actually expecting further weakness. And this on the monthly, technically, is screaming out that we're going to go down. So I would say, back to your question here regarding cable, longer term, I'm expecting that once we break 150, we're not going to see a long time before we're back at 134 and below. And below that, we're making new lows, okay, in the pound. Once we get below this level here, there's not a great deal to go at. So if you look at that from the weekly perspective, you know, what it's telling me is we're trading fundamentally now, pricing in that interest rates are going to go up in the US before the UK. That is going to bring fundamental short into the market. Technically speaking, again, you could do Fibonacci. You could do anything you want. You know, from the low to the high here, where's that 50%, okay, that tells us what the market's thinking? Well, surprise, surprise, it's here, okay? And it ties in well with this trend line. So if the market was going to, okay, sell off, which it did from this little rally we had, the market would have bounced and gone on to make new highs and get towards these upper fibs, you know, these higher levels, but we haven't. So on the weeklies, we're looking weak again. I mean, look at this support and resistance level. This is technical trading right here. Yeah, these levels that we go down, we break back, we test the upper level that was support, which is now resistance, and gone down. And look at that trend line that we got from the monthlies, how it reacts on the weeklies. Okay, so go back to your dailies. See how the market works. I mean, this is how, you know, when we talk about higher time frame trading, look what happens on the bigger picture, things that we know are absolutely concrete, set in time. So a monthly candle, think about how many hourlies, how many minute candles and a monthly candle holds. It's a huge amount of data. So we take that direction, we take that understanding from the monthlies, move it to your weeklies and dailies, okay, and then use it on our smaller time frames to trade. So really, it is just screaming out that all these key points that should be holding the market and making it bounce are not. They're breaking through. Okay, we're not bouncing off levels. We're not looking to go higher. We're breaking, so we're looking to go lower. So this area here tells us, this area here, big sell-off, gap. Gap gets closed, gap continues down. Okay, we make our way back up, but we're below that monthly trend line. We're below that 50%, okay, that we saw in the weeklies. We're below all the levels. So as we hold below this level here, okay, this 23.6, the next point is down here. So what we could say is from here where we're trading, put your stop here of 50 ticks in order to make 450 ticks. Or you don't have to. You know, again, I'm never looking to make 450 ticks in a trade. I'm just looking to get value. So just pull out a point of interest here. Yeah. So if the market's going to drop, yeah, put your stop up here and you take your profit out down here. So I'd say really that we're looking to get below 1.50 in kind of all time frames on the pound versus the dollar. So every time we see the market make any attempt to go higher, we see a sell-off. Okay, so all we're doing is selling high. Yeah, so look for a high point. If you think this is a high point here, sell high. Potentially, I would say that as long on the hourly charts, if you don't get above 1.52636, you've got a good opportunity to go short because you haven't got back into this region here. So there's more people short than there are long. Okay, and unless something comes out from Mark Carney in the Bank of England or something happens today to say that interest rates are going to go up before the US, then it can only go down, can't it? Okay, there's nothing here that's going to see a hard bounce. We couldn't see it on the monthly charts. Yeah, we had our opportunity to do a hard bounce here. We needed to close above this trend line and go up. We didn't, so we're going to go down. It looks just the same on the weeklies. We've had our profit taking from this big down move. Yeah, we're going to make it back to upper levels. Would have held on. We see a big rejection here. Then the next week opens down. So it's open season for selling the pound now. Okay, another technical look. So I hope that answers your question. But basically, yes, we're going down in the pound versus the dollar. So got 5 minutes before the Bank of England today. We're expecting unchanged, obviously, but it doesn't mean that there won't be some clue about forward guidance. Doesn't mean there won't be something said. I mean, this is the reason why I have my chart set up this way. You know, it's a fairly simple setup, to be honest. You know, I'm not trying to. I don't need to have 10 screens. I don't need to have all this kind of stuff that people think you need to be a professional trader. What I'm armed with is a good understanding of what can happen in the past and therefore what can happen in the future. So all these green and red lines mean something to me. So I use these to trade. So I look at the DAX. Okay, the DAX is leading the markets. So every time the DAX has strength above this 50%, I might look to buy low points in the S&P. S&P is trading here at the 423 hourly retracement. Big sell-off, big rejection. DAX isn't making new highs. Okay, buy some S&P. This is the correlations you need. DAX, FTSE, US 500, S&P. Then we've got gold. So if these go up and continue to strengthen, gold's going to naturally weaken. You've got the SMI here. Lots of value buying in the SMI. Okay, then you've got other things like the dollar, Japanese yen. We're seeing all this strength come into the dollar, and therefore we see strength in the dollar in this corner. Then we're going to see weakness in the pound here. So it's a good idea to have a good broad section of markets and a good cross section of what you think is going to move the markets, and then just trade direct correlations, inverse correlations, trade individual markets technically, individual markets fundamentally. It's all a big, way of marrying these things up. There is no one way of trading. There is no one universal way of understanding the markets. It's a combination of understanding various types of people, various different people that trade over different time frames, various technical fundamental reasons. It's all a big mishmash. And the only thing, as I keep stressing, that you can control is yourself. Only you can control what you do when you buy, when you sell. And trading is not difficult. Okay, all you're doing is clicking a mouse. The difficult part is dealing with the emotions that come with trading live money. So if you think the euro is going to be strong, then you buy some euro down here and let it continue to strengthen. I don't see how anyone can justify that. But again, what's the chart told me? Okay. Every time we're high in the euro, it sells off. So it's sold off from here. We've not been able to get back to the 50% of this. We know that just by pure line of sight. And every time on the hourlies we've got above the Bollinger Bands, market's gone down. Market's gone down. Market's gone down. Below the moving average now, market's gone down. Okay, can't get back into this range, market's gone down. You can look at charts and be that blatant about it. The fundamental reasons for the euro going down, again, are all the concerns about when Greece will exit the eurozone. So you all think it's fixed, because Greece have agreed to play ball with the EU. Nonsense. Okay, Greece will leave the EU. They will leave the euro. Okay, the euro is finished. I've also been saying that for the last 2 years. Might not happen today. Might not happen next week. Might happen in 2 years' time. But it's going to finish. Okay, all the money's been spent. There is no turning back. Anyway, as I said, every time we hit a high point on intraday charts, we go lower. So you have to identify in the future what's going to happen. If this is the absolute stone cold low of the euro, buy as much as you want and expect it to get back to these levels and upwards. If not, find an intraday point of where you think that is a high point and sell it and watch this trend continue. That's how you trade. Simple as that. Okay? All right, guys, just a minute or so now for the Bank of England. We're not expecting anything from the main rate announcement, any kind of change in that. But what we're looking for is a ripple through of either technical positions, a ripple through of anything that might be said that relates to the UK, that relates to the UK economy, interest rates, forward guidance, anything. Okay, as I've said time and time again, the markets have moved. Based upon not what has been said, what hasn't been said. So, it's not about, it's not about being right in your opinion. It's about looking for an intraday event such as this Bank of England that might be a precursor to the ECB, that might be a precursor to the Fed, that might be a precursor to the NFP. It might have no relevance at all. But right now, I know traders will be listening to what he said. So that where there's traders, there's fear, there's greed, there's money to be made. So if we think we're high in the indices, maybe we see a little bit of sell-off. If we're low in the pound, maybe we'll see a bit of buying. Okay, so what we're going to do is wait and hear what is said. Okay, so just waiting for that now. Not long now, guys. Just about 10 seconds. Unchanged. So we knew it was unchanged. Let's listen now for the news wires to see if anything else is picked out, if anything else is said. Okay, see if we can see any kind of technical shift in the markets, any opinions being formed, any kind of precursors. So gold really has rejected these kind of intraday movements lower. Okay, nothing coming through from the Bank of England yet, so nothing really being said. Still remaining fairly strong in the indices. Okay, we've just peaked away from the top in the DAX, but we're still trading, record highs. FTSE again, we're literally, again, if you just bought when I started this webinar, you'd have made money. And I said, keep buying the FTSE until we hit 7,000. It's absolutely inevitable. We were, no time at all. We gapped down lower today, closed that gap, and gone on to make new highs. All these things from a technical perspective are screaming, buy me, screaming buy me. And as you keep saying, the DAX is a good one to look at, top left of your corner, because that's driving the markets. Nobody knows where the DAX is going to stop. Nobody. There's obviously, technical analysts and there's, people that can give you a good idea. But as you're making, aggressive record highs day in, day out, that is going to drag the rest of the markets up. Okay, so yeah, I mean, basically, I'm saying that. Well, I mean, if cable gets down to one spot 45, would I expect one spot 48 to be a good buy? I mean, it all depends what you're trying to achieve. Okay, I would say that I trade in either one of two ways. I'm either trading a breakout, so I'm selling or buying into momentum up or down, or I'm looking for an intraday, hard reversal, hard bounce. So I might let the pound drop all the way this way down, and I might buy it down here for 50 ticks, just a bounce. It all depends how the market's behaving. I trade off the hourly, so I'm always looking at this. So what I want to do is see the market move very, very aggressively. And like this, I saw the market move very, very aggressively. So I would probably buy down here just for that green candle. But I'd buy, 50, £100 a point, and I'd get out just here. Yeah, and then I'd look to sell here and maybe get out here. I'm not looking to get this entire move here. I'm not looking to get any kind of a big sustained directional move because I'm looking for intraday movement. So I'm looking to hold a trade for anywhere between 15 minutes and maybe an hour, maybe 2 hours, and just take little bounces. It's very, very difficult to be right in trading, okay? If you want to be involved in the markets, I try to minimize the amount of time that my capital is tied up. So I like to be in, I like to be out. So I can say here, right, that at 152, I could sell £100 a point here and know that more than likely in a few weeks' time we're going to be trading around about 150, okay? But that's not how I trade, okay? That's more how I see investing. What I would like to see is the market really kind of rally aggressively back up this point here and then sell it for a few ticks, maybe for 20, 30 ticks. Yeah, up, sell it. And then if it comes down and breaks this level, sell it a little bit and get in, get out. So would I say one spot 48 is a good buy? It depends how it gets there. If it gets there in one candle, of course it's a good buy. If it gets there over a series of weeks, potentially it's a good buy. What I would say is, what you're trying to do is figure out what the value is. So the market gets down to one spot 48. You don't want to be waiting for it to get down to 148 just to buy it. What you want to be doing is looking for opportunities to sell it high and for it to head towards 1.48. You're looking at trading a little bit on its head there, to be honest. I mean, it doesn't matter where it's going to go. It's either going to go up or it's either going to go down. That's simple. But I mean, that's, again, what I said to you right at the start of this presentation. That's trying to be right, isn't it? If you think that it is going to get to 1.48, then you're right. Pat on the back, Steve. Well done. You predicted that. But it doesn't mean you're going to make money from it. Okay, unless I'm selling every intraday high down to one spot 48, that's how I'd make my money. I wouldn't make my money by getting down to one spot 48, buying it, and then holding it. That isn't what I'm trying to do. I'm trying to teach you how to intraday trade. So, look at the 15-minute charts. I think it's going to get down to 1.48. Use the Bollinger Bands, yeah? Use the moving average. Every time we get to these high points, there's a good opportunity to sell. So maybe I just sold below this support level here, below the Bollinger Band, and bought back at this level here, yeah, or this monthly level. Yeah, I wouldn't have made a great amount of money out of that, but I might have made 22 ticks. Now, 22 ticks, £100 a point, that's a lot of money. Okay, so then it might not break this level here, this level at 1.52360. Where's it going to go after that? Well, I don't have a lot of levels until here. So if we do break down, then I'm expecting the market to have an aggressive sell of 200 ticks and get down to 1.50346. So I'm not going to hold it for 200 ticks, but I might sell a break and get 20, 30 ticks out of it. Consolidation might sell another break, sell another break. So I might have made 2, 3, 400 ticks selling little bounces all the way down. If that's what I think, if that's where I think value is. So don't try and say is 1.45, a downward trend, or is 1.48 a good point to buy. What you're looking to do is say if the market is likely to get down to 1.48, where is a good high point in the pound versus the dollar to continue to sell to get the benefit of that momentum and get the benefit of that direction. That's how you make money intraday trading. It's not about being precisely right on where the market will and won't go. It's about how it's going to get there and making money intraday. So as I can say, the charts don't really lie, do they? So you can look at any time frame. Every time that we're hitting highs, in the pound versus the dollar, we're looking weak. So we stop looking for them hard bounce anymore because they don't exist. So there's no value on the intraday charts in buying the pound. There just isn't. So maybe that's all priced in that the US are going to move first on rates. So every high we see in the pound, we just now sell it because this monthly view of this profit taking here is now going to be replaced probably by a red candle. And then what happens is you see 7 months of selling, one green, 1 month down to take all that profit away, and then another 7 months of selling. So I would say realistically in the pound, we're looking like we're going to get down to sub 1.35 and below. And that is on the presumption that the interest rate is going to move first in the US. And if they do, we're going to see nothing but dollar strength leading to that and nothing but weakness in everything that's priced against the dollar. It's that simple. So what we're looking for really here is, again, continuing my theme, buying low in the indices. So the FTSE, every time it sells off, just buy as much as you can. Because every time it aggressively sells off, we go up, all right, we go back down to make new lows. But what happens then? We hit good points of support and we go back up. We gap down, we buy it back up, we go back up. So look at the dailies on the FTSE. Every time we try and sell off and can't hold towards them lows, the next day is positive. Rejection, positive, rejection, positive, rejection, positive, rejection, positive, rejection, 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 positive, rejection, positive. Okay? It's almost like a little rhyme, isn't it? Rejection, positive. So all we have to do is wait for that market to get to 7,000. What's above 7,000? I don't know. I don't really care, to be honest. But as I've said, in every major publication in the world, things you'd have to pay millions of pounds for on, the hedge fund managers. I have said you buy every dip, every low point, and I said that back here. Okay, we had this sell-off. Okay, but you just stop doing that. When it comes back and you start buying every low, and it goes higher the next day, you do that. You'd have made about 3, 4, 5,000 ticks just by buying every rejected low on the dailies, like I've said. And as I've said, we're going to break all these tops here that couldn't remain short in the market. So once we get above 1.97047 again, we're going to hit 7,000. We're going to hold above 7,000 for, I don't know, a short period of time. I don't suspect, to be honest, that the FTSE is going to hold above 7,000 for that long. It's taken too long. The DAX got above 10,000 and then quickly got to 11,000, is way above that now. It's taken the FTSE too long to catch up with the S&P, the DAX, the recovery in the SMI and other markets. So I'm expecting to hit 7,000, probably trade above it, get to 7,100, and then pretty much that's it for the FTSE. I would suspect we start to come down quite aggressively because by that time we'll have had the election. We've realised that everyone's doomed. Everyone that has, buy-to-let property or a massive mortgage, interest rates are going to go up. The £1.4 trillion of personal debt is going to kick in, and it's game over. So FTSE is going to hit 7,000 for a short period of time, and then it's going to massively correct, as is the DAX, as the S&P. But as I said, that's an opinion. We're not interested about being right, but interested in being right at the right time. So we don't want the FTSE to hit 7,000, then correct 1,000 points in a day. We want the FTSE to hit 7,000. We buy all the way up. Then we sell a high point in the FTSE and just make little bits amount of some money on the way down. That's what trading is all about. Okay? That's what it's all about. Being right at the right time, taking your profit out and not leaving money on the table. Every one-to-one client that I've mentored over the last probably 2 or 3 months has lost their money by holding trades. A lot of people thought they'd picked the high in the DAX and sold it. DAX has gone on to make new highs. People have lost money. Stop thinking that you know more than the market. Having an opinion is dangerous. throw your opinions out the window. Have a rough idea. So we think the cable might get down to 1.48. Great. We don't hold it until 1.48. We don't buy it at 1.48. We just get involved in the markets. We sell every high point, anticipating 1.48 will be a good low. Okay, that's how winning is done in trading. Consistently getting involved in the markets, buying values that are low down, cheap, yeah, and then selling value where it's overly bought and over expensive, and then getting out. That is how you make a successful trader. Getting in, getting out, managing your risk. When you're wrong, get out, try another trade. When you're right, get as much money as you can out the markets quickly as you can and repeat. That's it. All right, guys. Well, listen, anything else you want to get me on, just tweet me at Steve Ruffley. We had a bit of a problem with the schedule today, so not the usual numbers. We didn't kind of schedule it until late on. But there's plenty more coming from me on FX Street in the future. And obviously, a big one is tomorrow on on-fan payroll. Again, good luck with that. Anything you want to know, guys, outside of that, just get me on Twitter or just email me, sruffley@tradermaker.